So the greater fool theory is built on the premise that there will be someone willing to pay more for the same asset, regardless of the fundamentals. So let's start with a story. Lizzie is a recent law school graduate, desperate to get out of her student debt. On a Friday night in a bar, she overhears a conversation about the recent rise of Bitcoin and remembers how her classmates profited off of it a few years ago. Then her interest piqued by the conversation and she registers a Binance account and buys some Bitcoin, hoping to sell it for much more down the line. Without her knowing, this investment strategy is predicated on the greater fool theory, the idea that investors can make money buying an asset while completely disregarding the fundamentals, simply because there will usually be someone to sell it to at a higher price, and that's the greater fool, whether the asset is overvalued or not. With the greater fool theory, investors not only ignore overvalued levels, they completely disregard valuations, earning reports, intrinsic value, or any fundamentals for that matter. It is merely based on the thesis of someone else will pay more. This theory works in principle, but when the market runs out of greater fools, the last colloquial fool will be left holding the bag. So in financial markets, the theory becomes incredibly relevant after an extended period of upside. After such a period, the rally becomes driven by the anticipation of further upside and the emotions of euphoria and greed rather than the fundamentals. So in these cases, the greater fool theory suggests that buying can always be justified. Now let's talk about some of the examples of the greater fool theory. Essentially, the greater fool theory becomes relevant during speculative bubbles. So with more and more people hoping to make a profit, it usually does not take long before a market bubble forms and eventually bursts. So let's look at a few examples of the greater fool theory in practice. First off, we have the dot-com bubble. So in the late 1990s, global excitement about the then new internet technology pushed American technology stock prices through the roof. At the end of the century, both retail and professional investors flocked to technology stocks to get rich quick, buying into stocks like Pets.com, Boo.com, World.com, and Microsoft at unprecedented rates. This buying frenzy caused the US NASDAQ index to rise from just $1,000 to more than $5,000 in just under 5 years. So eventually the hype died down and the influx of new money dried up, and no greater fools were left to buy, resulting in a market sell-off. Many of these stocks that Wall Street loved before the market crashed eventually went under, and out of the examples we mentioned, only Bill Gates' Microsoft made it out alive. Next, we have the housing market bubble. So another famous example of the greater fool theory in action, the financial crisis of 2008. More specifically, the cause of the global crisis. In the years leading up to 2008, the American housing market went through a tough time. Home ownership peaked in 2004, and after which home prices started to fall, and the number of new homes constructed dropped rapidly. So these were the first dominoes to fall, but the core of 2008's bubble lies in mortgage-backed securities, or MSBs, and also the ETFs built on these securities. In 2008, mortgage-backed securities went through a similar buying frenzy as the dot-com bubble, where more and more capital bought into the hype, buying even the securities backed by the riskiest mortgages. Mortgage-backed securities are claims to the cash flow generated by large pools of mortgages, most commonly the income of residential real estate. When interest rates increased, borrowers were no longer able to pay their mortgage obligations, resulting in mass defaults on their loans, and most mortgage-backed securities losing close to all of their value. Because hedge funds, banks, and private investors had invested more than $1 trillion in these MSBs, it didn't take long for these losses to spill over into the stock market, and a global crisis then ensued. And in this case, an unhealthy housing market with inflated valuations was the problem, but it was a greater fool investing that caused the global economy to crash down like a house of cards. Next, we have the 2021 IPO craze. So after the 2020 COVID pandemic hit, central banks across the world launched large-scale programs aimed at injecting liquidity into economies. With low interest rates, the stock market rapidly rose higher, and privately held companies wanted to take advantage. As a result, there were 1,035 IPOs in 2021 alone, many of which were listed far above their fundamental value. Nevertheless, social media and stimulus checks fueled another market bubble, where many new investors entered the market, pushing valuations to all-time highs. Eventually, the real-world economic situation caught up to the market, and the whole thing came crashing down once again. The moral of these stories is that when the greater fool approach becomes a popular investment strategy, a market bubble is usually right around the corner. So what are market bubbles? Well, as seen in the previous examples, a market bubble is a period where an asset or an asset class sees valuations increase rapidly until it runs out of buyers. After some incredible volatility around the peak, an even quicker drop in values follow, and this is usually called a market bubble burst. So now let's talk about crypto and the greater fool theory. Economists love to name cryptocurrencies as an example of greater fool investing, and understandably so. After all, many investors show little care about the underlying blockchain technology, most evident during the meme coin season, the ethos of decentralization and privacy. Nor do they seem to care much about the motivation behind Satoshi Nakamoto's invention of Bitcoin back in 2008. Economists often struggle to understand the fundamental value of digital assets, such as cryptocurrencies or NFTs, and therefore are quick to point to the tulip mania or greater fool theory as an explanation for the rise in cryptocurrency valuations over the years. So is crypto based on the greater fool theory? Well, while these economists dismiss cryptocurrencies and NFTs, they're not necessarily wrong. As we have seen before, extended periods of upside in any market attract a bunch of investors less concerned with the fundamentals of an investment, merely attracted by the potential of future profits. These people happily buy into Bitcoin, Ethereum, NFTs, and shitcoins just because they believe someone else will pay them a higher price for it later. Essentially, when economists refer to the greater fool theory at the heights of a cryptocurrency bull market, they're probably correct. Conversely, when they do so when the market is trending lower, these greater fool investors are mostly out of the market, being replaced by investors with more sophisticated motivations for buying into the market. Nevertheless, there certainly are tokens and NFTs in the market that are predicated purely on greater fool investing, with little to no intrinsic value or utility to drive upside. Should you ever try to use the greater fool strategy? Well, all things considered, the greater fool theory is a very risky investment strategy that is not recommended for long-term use. Nevertheless, with proper risk management and a bit of preparation, it can help generate significant profits, especially in the early stages of a bull market. Be wary once a greater fool investing starts to become the popular investment strategy among the general public. This is usually a sign that time is running out. How to avoid becoming the greater fool? Well, during speculative bubbles, it makes sense to be wary of the sell-off that will inevitably follow, especially if you've been on the wrong end of one of those sell-offs before. Emotions will likely run high when the market soars as hard as it can during the crypto bull markets. Whenever it feels like the market is irrationally high, chances are that you are buying into overvalued assets. And this does not have to be a problem, but it is important to be cognizant of it. So let's dive into a couple tips to help you avoid becoming the greater fool. So first off, financial markets are unpredictable. For the most part, financial markets are hard to predict, and keep this in mind as you trade, especially how it is nearly impossible to know when the hype-fueled rallies come to an end. Next, diversify your portfolio. Diversification is one of the best ways to protect yourself against any risk, even the risk of becoming the greater fool. If your portfolio is well diverse across markets, the effect of becoming the greater fool is not as detrimental as it would be when you would go all in on that one bet and have a long-term mindset. So most greater fool investment theses are built on the expectation of gains in the short term, sometimes even less than a day. When an investor plays the longer term, they care less about the short-term fluctuations in price. In fact, a long-term investor might view such a buying frenzy as a great opportunity to sell some of his positions and to buy it back later after the prices come back down. Don't blindly follow the crowd. So this goes without saying, but investments should be made at your own discretion, not by blindly following the crowd or someone on Reddit or Twitter. So all in all, the greater fool investment strategy is a risky approach to trading that usually gains popularity in the heights of a bull market. Historically, hype-driven rallies have resulted in sharp corrections, suggesting greater fool investing does more harm than good. When it comes to crypto, the greater fool theory applies as well, especially during an altcoin season or an NFT mania, but less so during a crypto winter. And it's recommended to make trading decisions based on careful analysis rather than strategies such as the greater fool's theory.